This have been familiar with David Trading Academy, India's premier academy for futures and options trading education. And to start off with why we started this, as we have already discussed about the massive surge in volumes in futures and options of lately. If you see here on the right hand side column, the turnovers in the exchange is rising rapidly in futures and options and in derivatives. Okay, obviously for multiple reasons that of course Manish will take care of it with better opportunities to trade, lower capital employed, and capital protection in options and futures. That's how we really wanted retail traders and participants, common traders, to understand futures and options trading. That's how we launched this company, and privilege and honor to have a great response from market with our offices in Mumbai, and now last year we expanded to Bengaluru as well. So great being working with you guys and hosting you for the seminars. And of course, apart from the trading volumes in derivatives, the comparison, if you see in cash and futures and option segment, that is what we really want to highlight and make you understand. Okay, how this works, why people are migrating to options trading, and why there is a certain surge in volume. That's what Manish will take in this webinar today, and of course, in our program starting this Saturday, you will understand the trading methods of futures and options. These are just the key facts and figures that we just wanted to highlight. Okay, and before we proceed, about your speaker, I'm sure all of you needs no introduction about a managing director, fund manager, a trader in all these three companies. You might have seen the speaker on every news channel, media channels in CNBC, 18 House, Bloomberg, and the speaker has a separate profile on the elite panel in the money control as well. Mr. Manish will give you a brief idea about how we're going to start this program on the Saturday. Okay, what ideas you need to know before this, the basics of options, futures, advanced concepts, as well as a lot of people in our seminar in Bengaluru just wanted to see how actually our strategies works in live market. How data analytics, how Excel oriented trade strategies we focus, and that's how we take positions in our trading methods. So that's what Manish will be telling you all about. Okay, I'll just hand it over to Manish. He's already here in our cabin. So all yours, Manish.
Basic call option, put option, correct? So introduction to basic options. Thus, you will learn in detail in the class on the Saturday, but I'll just brief you one basic part. One is call option, where if you're buying a call, your view is bullish. You are right to buy means you are betting to buy that market will move up. No initial margin because you are just paying the premium, so your risk is limited up to the premium. So your risk is limited, so broker's risk is limited and exchange risk is limited. So exchange will not charge you any margin. You have to pay only premium as a call buyer. Okay. As a call seller, if you are selling a call option, that is called a writer. Your view is not bullish, indirectly view is bearish. Obligation to buy means if market is moving up, whatever your call price, you have to square off that at whatever price. If you are not squaring off, exchange will square off on your behalf because exchange is there for the settlement guarantee in between buyer and seller. So whatever prices, exchange will square off the position, and whatever losses, it will be debited to your account. If you are selling a call, your risk is unlimited. So that is the reason why exchange will charge you additional margin, that is called initial margin, which will be equal to futures, short or buy. And you have to pay that margin, but you will receive the premium by selling the call option. If you are buying a put, your view is bearish. You are betting to that right to sell means you are betting to sell the market. No initial margin because you have to just pay the premium and your risk is limited up to the premium. And put option, if you are selling, then your view is not bearish. Indirectly view is bullish. Obligation to buy means wherever market moves downward, if your put price becomes, let's say, whatever, you have to square off that put at current market price on the expiry. If you are not squaring off, then exchange will square off on your behalf, and whatever the losses, it will be debited. So initial margin to be paid because your risk is unlimited, but you will receive the premium. So I'll just brief one shot here. Call option means, I'll just brief here one shot in a Google Doc sheet in a proper structured manner. So I'll just show you the Google Doc sheet, how the Google Doc sheet works. This is the application box. You have to click here. Oh, just wait 1 minute. Yes. This is the Google Doc sheet. You have to click here and this window will open. I think it is not open. Just wait 1 minute. What is Okay. So you have to click here. This window will open and you have to select here more. Okay. Then you have to click here Google Docs. So you will click on Google Docs. Then you have to click here Google Docs sheet. And then you will select here blank sheet or new sheet, whatever. So you can select multiple sheets. So I'll just open this sheet. Let's say untitled spreadsheet. So if you're buying a call, your view is bullish. I'll just do it on the downside. This was a previous webinar of this, so I'll just do it on the downside. If you are buying a call, your view becomes bullish, correct? Risk is limited and reward is, what will be reward? Unlimited, correct? You have to pay just premium and no need to pay margin. Have you understood this part? Buy call. Correct. And if you are buying a put, your view becomes bearish. Risk is limited, reward is unlimited. And you have to pay the premium, but no need to pay the margin. But if you are selling a call, sell call, then your view becomes indirectly bearish. Risk is unlimited and reward is limited. You have to pay margin but receives premium. Sell put means view is bullish indirectly, risk is unlimited, reward is limited, pay margin but receive premium. Correct? Have you understood this part? Have you understood this part? Mr. Anup, Arvind, Avinash Rai, Balakrishna Shinoy. Okay. So these are the most important part of your options: intrinsic value and time value. Many of the traders trade in options, but they do not know what is the intrinsic value and what is the time value. If you do not know how to calculate this intrinsic value and time value and what is the impact of this intrinsic value time value on your trades, if you do not know, then it will be very much difficult to make profit. These are your base of options. Okay, as an options trader, you must know all of this: how to calculate intrinsic value, how to calculate time value, and everything. Mr. Vinayak, Suhail, Subramanya Bhatt, Siva Kumar, all these students, those who have signed up, you will learn all these things right from the detail, right from the start on this Saturday, 15th April morning when the batch started. So all those have signed up Don't worry, you will learn in this detail on the Saturday morning. But I'll just give you an example how the intrinsic value and time value affects and how it is calculated. Okay. So let's take a practical example, live example. So better we take the prices from the terminal. Okay. So let's take a terminal live prices of Infosys. Currently trading Infosys at 934 and just seeing the prices of put option 950 put option. Okay. 960 put option. So currently 960 put option, 960 put of Infosys. What is the price? Can you see the price? What is the price here? 32, 33 rupees. Correct? Are you able to see the screen? Raju, Prabhu, Parmeshwari, Naveen, are you able to see? Okay. So currently, if you see 960 put option currently trading at 33 rupees. 33 rupees. 960 is called strike price. This is called strike price. This is called option premium. Okay. So currently future prices are trading at 935. Okay. So now we'll calculate intrinsic value and time value for this. Intrinsic value and time value. So as per this formula, the top of the formula, intrinsic value equals to current stock price minus strike price. This is the formula for calls. The middle one formula, intrinsic value equals to strike price minus current stock price. This is for put and this is applicable for both. Again, I'm repeating, the number one formula is for call, number two formula is for put, intrinsic value, and number three is applicable for both call and put both. Okay, for calculating time value. So now I am calculating the intrinsic value of put. So which formula I will apply? First or second? Which formula apply? I want to calculate intrinsic value of put. Which formula I will apply? Very good, Avinash and Prabhu Kumar. Very good. Answer is second formula I will apply because that is of put formula. How to calculate intrinsic value. So intrinsic value equals to strike price minus current stock price. So intrinsic value of this, intrinsic value, or you can say it is also called as actual value of options of this strike actually. So intrinsic value equals to option premium, strike price minus current stock price. Correct. So strike price minus current stock price. So strike price is what? Strike price is 960. Stock price is 935. So 960 minus 935. So actual value, intrinsic value of this put becomes what? 25 rupees. So out of these 33 rupees premium, 33 rupees whatever premium, current premium of this option, the fair value of this option is how much? 25 rupees only. Okay. Now we'll calculate the time value. This is intrinsic value. I'll just write it down. Now we'll calculate the time value. Time value of this option. So time value will be, what is the formula of time value? Option premium minus intrinsic value. So option premium is how much? 33 minus intrinsic value is how much? 25. So 33 minus 25, which becomes 8 rupees. So 8 rupees becomes what? Time value. Correct? This is you have understood. So out of 33 rupees total premium, current premium of this option, 25 rupees is the actual value. 8 rupees is what? Time value. This part you understood? All of you please reply. This part you understood? Bipin, Balakrishnan, Harish, Loganathan, Manoharan, Mansoor, Mohammed. Okay, so if let's say we assume today expiry, we assume today is today is expiry day, and Nifty expires, or sorry, Infosys expires. This is Infosys. So Infosys expires exactly at the rate rupees 935, which is the current market price. So if Infosys expires at 935, then intrinsic value, the final option premium will be intrinsic value plus time value, correct? And time value. So intrinsic value will remain same, which is 45 rupees, but time value will become 0 because no time left for expiry. So time value will always be 0 on expiry. Have you understood this part? So time value will become 0. So final value of this option of this strike will be 25 rupees only. Have you understood? So if you are a buyer, you will face a loss of 8 rupees. Current option premium this is. So if you are a buyer, you will face a loss of 8 rupees. If you are a seller, you will make a profit of 8 rupees. Have you understood? Have you understood this part? Correct? That is the reason why if you are buying options, and prices do not move, then also your premium start reducing. That premium reducing is time value reduction. This is what called time value theta decay. Okay, all of you will you understand in the class in detail, but I'm just giving you a snapshot of how the intrinsic value and time value affects your options.